Wise men buy gold when the streets are running with blood, but the truly powerful accumulate it long before the first drop ever falls. This unwritten maxim of the financial markets has never been more relevant than it is right now. While mainstream media distracts the public with daily stock volatility, monthly inflation metrics, and political theater, an unprecedented financial realignment is unfolding in the shadows of global capital markets. Warren Buffett famously noted that it is only when the tide goes out that you discover who has been swimming naked. But what happens if the largest financial institutions on Earth already know that the tide is about to vanish entirely? What if central banks are no longer merely tweaking interest rates, but actively preparing for the systemic reset of the very monetary architecture they created? Pay close attention to what is happening right beneath the surface. Global central banks have been purchasing physical gold at a record-breaking pace, unmatched since the end of the Second World War. Major commercial banks across America and Europe are quietly expanding their emergency liquidity buffers to historic highs. Wall Street titans from Ray Dalio to Stanley Druckenmiller are systematically reducing their exposure to traditional equities and shifting capital into tangible, unencumbered assets. This is not a coincidence, nor is it routine portfolio rebalancing. This is structural crisis preparation. To grasp what is being orchestrated, one must internalize the fundamental rule of institutional finance. Banks never warn the public before closing the doors. As Baron Nathan Rothschild famously declared in the 19th century, "Give me control of a nation's money, and I care not who makes its laws." Today, those who control the money supply are issuing deafening alarm signals, but they are speaking in a technical language that 99% of the population cannot decode. For decades, the global financial engine has relied on a single core belief. U.S. Treasury debt is the safest asset on Earth, and the U.S. dollar is the undisputed king of world trade. This arrangement, born out of Bretton Woods and solidified through the petrodollar system in the 1970s, enabled unprecedented global economic expansion. However, it also engineered a monster, a staggering global debt pile exceeding $315 trillion. Ray Dalio, founder of Bridgewater Associates, spent his career studying the big debt cycle. In his research, he proves that every major financial empire progresses through three distinct stages: emergence driven by productivity and sound currency, top-tier dominance fueled by debt expansion and cheap credit, and an inevitable decline brought on by monetary debasement and endless money printing. We have arrived precisely at the tipping point of this final phase, and institutional bankers understand this dynamic better than anyone else. The economist Ludwig von Mises predicted this setup with absolute precision when he wrote that there is no means of avoiding the ultimate collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as the result of a voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved. Governments have repeatedly chosen continued credit expansion over voluntary discipline. The eventual fallout is precisely what central banks are insulating themselves against behind closed doors. While the public was told for years that physical gold was an obsolete asset, a barbaric relic with no yield, institutions were quietly positioning themselves. Under the Basel III regulatory framework, established by the Bank for International Settlements, physical gold was reclassified as a Tier 1 asset, placing unencumbered physical bullion on the exact same risk-free status as cash and sovereign treasuries. Why would global regulators elevate a physical metal to top-tier reserve status if the paper system was functioning smoothly? The answer is brutally simple. Banks recognize that counterparty risk, the threat of sovereign defaults and broken promises, has reached its highest level in modern economic history. They are preparing for a sovereign debt restructuring event. When interest rates rise against an unmanageable debt load, paper assets held on bank balance sheets suffer immense unrealized losses. This exact dynamic triggered the collapse of regional banks in recent years, but the core issue is not isolated. It is systemic. While retail investors celebrate artificial market highs driven by a handful of mega-cap stocks, institutional managers are locking down liquidity, tightening credit conditions, and quietly migrating into ironclad reserves. They are not panicking, they are positioning. In high-level finance, the first to panic gets destroyed, but the first to position builds generational fortunes on the remnants of the old system. The transition from a paper-based monetary regime to a hard asset-backed system never happens smoothly, and history demonstrates that the public always bears the brunt of the adjustment. When sovereign nations face unsustainable debt burdens, they inevitably resort to a combination of currency debasement and financial repression. Financial repression is the subtle mechanism by which governments artificially suppress interest rates below the rate of inflation, effectively transferring wealth from savers and bondholders directly to the state to liquidate national debt in real terms. While mainstream financial commentators urge retail investors to remain passive in traditional index funds, institutional architects are actively preparing for the mechanics of a bail-in regime. Unlike the bailouts of 2008, where central banks printed money to rescue failing megabanks at the expense of taxpayers, modern legislative frameworks across major Western economies have officially codified bail-in protocols. Under these regulatory rules, when a major financial institution faces insolvency due to massive unrealized losses on sovereign bonds or toxic derivative exposure, the bank is legally empowered to convert uninsured depositor funds and senior debt into equity to recapitalize itself. In plain terms, money left sitting in a commercial bank account is legally classified not as a bailment, but as an unsecured loan from you to the bank. When the bank stumbles, your capital becomes its lifeline. This is precisely why sophisticated capital managers are quietly withdrawing excess liquidity from the commercial banking system and allocating it into assets with zero counterparty risk. The legendary investor Warren Buffett has systematically built an unprecedented cash and treasury stockpile, not because he dislikes buying businesses, but because he recognizes that the current valuation landscape is artificially inflated by excess credit that must eventually contract. As Buffett famously warned, "Price is what you pay, value is what you get." In an environment where asset prices are distorted by central bank intervention, true value becomes exceedingly rare. Meanwhile, Ray Dalio has repeatedly highlighted the danger of holding cash during late-stage debt cycles, calling cash the worst long-term investment because central banks will always choose to inflate away debt obligations rather than allow a complete deflationary collapse. This creates a severe paradox for ordinary individuals. Holding traditional currency exposes you to guaranteed purchasing power destruction through inflation, while leaving capital in the banking system exposes you to systemic bail-in risks during a liquidity freeze. The global elite resolve this paradox by purchasing physical, tangible assets, farmland, energy infrastructure, precious metals, and essential commodities that possess intrinsic utility and cannot be printed into oblivion. The structural fragility of the present moment is further compounded by the rapidly shifting global geopolitical architecture. For over 50 years, the recycling of global trade surpluses into U.S. Treasury securities provided an endless bid for American debt, keeping domestic borrowing costs low and funding perpetual government deficits. However, major foreign nations are no longer willing to absorb this debt at current yields when the underlying currency is being systematically diluted. As foreign central banks reduce their holdings of sovereign paper, the domestic central bank is forced to become the buyer of last resort, monetization of debt that directly accelerates currency degradation. We are witnessing the classic setup described by the Austrian School of Economics, a crack-up boom where the loss of confidence in the future purchasing power of money drives a desperate rush into real goods, setting off a feedback loop of rising prices and further monetary expansion. Institutional insiders are not waiting for the final cascade to begin. They are executing their exit strategies with surgical precision today, while the broader public remains unaware of the structural shift taking place right beneath their feet. To fully grasp the magnitude of the coming transformation, one must look at the hidden mechanics of global liquidity and the repo market. The repo market is the central circulatory system of modern finance, where banks and major financial institutions trade trillions of dollars in short-term loans, backed by government bonds every single day. When this market experiences friction, the entire global banking architecture threatens to freeze in a matter of hours. Back in late 2019, long before the public was aware of any impending economic disturbance, the repo market experienced a sudden, catastrophic spike in interest rates, forcing the Federal Reserve to inject hundreds of billions of dollars overnight to prevent a systemic freeze. That event was a clear warning shot. The collateral underlying the entire financial system was becoming impaired and scarce. Today, that exact same structural stress has returned, but on a vastly larger scale. Commercial banks are holding hundreds of billions of dollars in unrealized losses on their balance sheets because the government bonds they purchased during periods of record low interest rates have plunged in market value as rates rose. In an era of instant digital bank runs, where depositors can transfer billions of dollars with a single click on a smartphone, a bank's perceived solvency can evaporate in minutes. The collapse of Silicon Valley Bank and Signature Bank was not an anomaly caused by bad management alone. It was the direct symptom of a fundamental mismatch at the heart of fractional reserve banking in a high-rate environment. When the central bank steps in to backstop these institutions with emergency lending facilities, it creates a deadly dilemma. If the central bank continues to print money and provide liquidity to save failing banks, it fuels relentless price inflation and degrades the purchasing power of the currency. If it stops providing liquidity to fight inflation, the banking system faces immediate credit contraction and insolvencies. This is the ultimate monetary corner from which no central bank in history has ever escaped without debasing its currency. As the famous economist Milton Friedman observed, inflation is always and everywhere a monetary phenomenon. When governments run persistent multi-trillion-dollar deficits while central banks monetize the debt, the inevitable result is a steady erosion of real wealth for anyone holding paper assets. Institutional investors understand this math intimately. They know that when national debt reaches a level where annual interest payments rival or exceed the national defense budget, mathematical reality takes over from political rhetoric. At that point, default by inflation is no longer a policy choice. It becomes a mathematical certainty. The legendary investor Paul Tudor Jones echoed this reality when he noted that in an environment of runaway fiscal spending, holding fixed income bonds is equivalent to sitting on a ticking time bomb. This realization is driving a massive, quiet migration of capital out of traditional paper instruments and into scarce, hard assets that lie outside the direct control of the banking system. While retail investors remain focused on short-term quarterly earnings reports, sovereign wealth funds, family offices, and central banks are restructuring their core balance sheets for a world where sovereign promises can no longer be trusted at face value. They are insulating themselves against a structural reset of global trade settlements and currency regimes, ensuring that when the current credit bubble finally bursts, their wealth remains intact and fully backed by tangible value. The structural weakness of the current financial system is not limited to domestic sovereign debt and domestic banks. It extends deep into the global monetary network known as the Eurodollar system. The Eurodollar market represents trillions of US dollars held in foreign banks outside the direct regulatory jurisdiction of the Federal Reserve. This vast, offshore credit engine operates as the primary source of global trade financing and capital allocation. However, because it relies on complex networks of international counterparty trust and unbacked leverage, it is exceptionally vulnerable to sudden liquidity shocks. When international banks lose confidence in the quality of collateral circulating through this system, global credit contracts violently overnight. This hidden fragility is precisely why central banks around the world have been quietly establishing currency swap lines and restructuring their international trade settlement mechanisms. We are witnessing the gradual but irreversible fracturing of the unipolar financial order that has dominated world trade since the end of the Cold War. As geopolitical tensions rise, major trade blocs are accelerating their efforts to bypass the traditional dollar clearing networks altogether. They are settling energy transactions and key commodity contracts in regional currencies, or anchoring them directly to physical gold. This process of de-dollarization is not a distant future probability. It is an active operational reality that is reducing the global demand for paper assets issued by Western nations. When foreign central banks and foreign nations stop recycling their trade surpluses back into Western government bonds, the domestic government loses its largest captive buyer. The result is an escalating feedback loop. Bond yields are forced higher to attract marginal buyers. Higher yields dramatically increase the government's interest burden on its existing mountain of debt, and the central bank is ultimately forced to step back in and print the difference. This dynamic leads directly to what monetary historians call fiscal dominance, a state where central bank monetary policy is completely hijacked by the government's fiscal spending needs. Under fiscal dominance, controlling inflation becomes secondary to ensuring the government does not default on its obligations. When a society reaches this point, paper money rapidly loses its primary functions as a reliable store of value and a predictable unit of account. Legendary hedge fund manager Ray Dalio has repeatedly pointed out that when internal debt levels become unmanageable alongside external geopolitical friction, the historical playbook always points to one outcome: large-scale currency debasement accompanied by strict capital controls and structural asset reallocation. Institutional capital managers who understand these historical cycles are not sitting idle while their purchasing power is systematically liquidated. They are actively divesting from low-yielding paper promises and shifting balance sheets into hard commodities, industrial resources, independent monetary assets, and strategic real estate. They recognize that in the final phases of a major debt expansion, the ultimate risk is not short-term price volatility in paper terms, but the permanent loss of real purchasing power. By securing unencumbered, tangible assets today, these institutions are positioning themselves to survive the systemic reset and acquire distressed assets for pennies on the dollar when the inevitable unwinding reaches its climax. The final phase of a global monetary realignment is never marked by a single sudden announcement, but by an accelerating series of systemic failures that force the hand of institutional regulators and ordinary citizens alike. As the underlying friction in the global banking network intensifies, financial authorities will attempt to maintain control by introducing next-generation monetary technology, specifically central bank digital currencies. CBDCs represent the ultimate evolution of financial programming, offering central banks real-time visibility and direct control over every transaction within the economy. Under the banner of efficiency, security, and crisis management, these digital tokens are designed to replace physical cash and traditional bank deposits with a centralized ledger controlled directly by the monetary authority. For retail account holders, this shift fundamentally alters the nature of private property, turning personal money into a conditional permission system that can be restricted, programmed, or subjected to negative interest rates at the push of a button. While the general population is presented with convenience, institutional insiders recognize this transition for what it truly is: a defensive measure by central bankers to lock in capital and prevent systemic bank runs as the underlying debt bubble collapses. This is why the smartest players in global finance are building their financial lifeboats today, well before access to exit ramps is restricted. The path forward demands an immediate departure from passive, conventional financial wisdom, relying solely on traditional paper portfolios, unhedged cash reserves, or standard commercial bank deposits in an era of unprecedented monetary debasement is no longer a conservative strategy. It is a guaranteed path to purchasing power destruction. As Warren Buffett famously observed, volatility is not synonymous with risk, and the greatest risk of all is the permanent loss of capital through subtle monetary erosion. The elite understand that surviving this structural shift requires owning unencumbered, scarce assets with no counterparty risk, assets that cannot be printed, devalued, or confiscated with a digital stroke of a pen. Whether through physical precious metals, productive real assets, or decentralized monetary networks, securing true financial independence is the only defense against the coming reset. The quiet preparations made by central banks and global megabanks are not speculative bets. They are the strategic maneuvers of institutions that know the current system has reached its mathematical limit. The window of opportunity to position yourself alongside institutional capital, rather than becoming collateral damage, is closing rapidly. If you found this deep macroeconomic breakdown valuable and want to stay ahead of the critical wealth transfers happening behind closed doors, make sure to hit the subscribe button right now and turn on all notifications. By subscribing to our channel, you join an exclusive community of forward-thinking investors dedicated to decoding institutional moves, protecting their purchasing power, and building generational wealth in a changing world. Thank you for watching, subscribe today, and we will see you in the next analysis.